Ladies and gentlemen, welcome back to the channel. Stocks are under pressure today because of Trump. Yeah, some comments are coming out of way higher tariffs than we expected on Europe. Now, Scott Besson has had a speech today. There's many other headlines I will share with you. But what Donald Trump had to say about Apple and about the EU are really the big negative catalyst for markets today. So first and foremost, the big negative news today is Trump recommends a 50% tariff on the EU starting June 1st. Trump on X, or on True Social, which was then shared on X, says, quote, "The European Union, which was formed for the primary purpose of taking advantage of the United States on trade, has been very difficult to deal with. Their powerful trade barriers, VAT taxes, ridiculous corporate penalties, non-monetary trade barriers, monetary manipulations, unfair and unjustified lawsuits against American companies, and more, have led to a trade deficit with the U.S. of more than $250 billion a year, a number which is totally unacceptable. Our discussions with them are going nowhere. Therefore, I am recommending a straight 50% tariff on the EU starting on June 1st, 2025. There is no tariff if the product is built or manufactured in the United States. Thank you for your attention to this matter." Now it says here, the Post tees up a potentially tense exchange between U.S. Trade Representative Jameson Greer and his European counterpart later Friday morning. Greer is expected to tell European Trade Commissioner Maros Sefcovic in a meeting that Brussels' latest move in ongoing trade talks fails to meet U.S. expectations. So, again, I think this is really just a tactic, not something that is actually going to happen. Now, could a 50% tariff happen? Of course. But I think it's really just like, hey, let's put on some pressure before we start, talking again over this weekend, and let's see how the EU responds to that. Trump did this with China, and it seemed to work. Heading into their meeting, there was a lot of progress done, just at that one meeting. Okay, so I think it's, again, more of like a scare tactic, art of the deal. Create chaos, confusion, distort, and I think it's part of negotiations. But Wall Street today doesn't like it. S&P's down about 1%. Now, Chicago Fed President Austin Goolsbee said Friday morning, quote, "To go to 10% was going to be the highest tariff rate that we had on the world in 90 years. To go to 50% is a completely different order of magnitude. Quote, if they're putting in place tariffs that have a stagflationary impact, which is to say they slow down output by raising the cost of production while also raising prices, then that's the central bank's worst situation." So I'll get into some more of those headlines from Fed officials today and other breaking news. But right off the bat, Austin Goolsbee is sounding pretty panicked from these headlines. Now, also in the news today, the U.S. and China hold the first phone call since the Geneva meeting, signaling progress in trade talks. So this news kind of flew under the radar a little bit. Again, that 50% EU tariff headline is really what people are focused on today. But it says, the U.S. and China have agreed to maintain communication. Analysts called the call a positive sign following the high-level talks in Geneva. They say, quote, "While the call may not indicate a breakthrough in the ongoing trade talks, it is a positive sign that Beijing now knows who to talk to on the U.S. side," says Dan Wang, China director at political risk consultancy Eurasia Group, adding that the communication channel established in the Geneva talks is working. Also, which is a pretty negative headline today, Trump says a 25% tariff must be paid by Apple on iPhones not made in the U.S. This is the latest jab at Apple from Trump, who over the past couple weeks has ramped up pressure on the company and Cook to increase domestic manufacturing. Production of Apple's flagship phone happens primarily in China, but the company has been shifting manufacturing to India in part because that country has a friendlier trade relationship with the U.S. Treasury Secretary Scott Besson said in an interview with Fox News on Friday that he was not part of the meeting at the White House, but the Apple situation could be part of the Trump administration's push to bring precision manufacturing back to the U.S. Quote, a large part of Apple's components are in semiconductors, so we would like to have Apple help us make the semiconductor supply chain more secure. U.S. Treasury Secretary Besson says Trump believes EU proposals have not been of good quality. And he says that Trump's move today is in response to the EU's pace on tariffs. And he says, we hope this lights a fire under the EU. Germany's foreign minister on Trump's tariffs says both markets would suffer. That's why we want further negotiations. And Besson says, I am not expecting the U.S. Senate to change the budget bill much. Besson says we are far along with India in trade talks. And he also says that most countries are negotiating in good faith, except the EU. Fed Goolsbee says today rate cuts are still possible over the next 10 to 16 month horizon. Goolsbee says, I still feel that underneath the volatility, the economy remains strong. If tariffs and uncertainty were not a threat to inflation, rates could eventually fall. Goolsbee says interest rates are still within historical ranges. If there was a crisis over U.S. fiscal stability, they would be moving higher. He says financial stability worries are so far overblown. Goolsbee says to the extent that long-term yields are moving higher that can impact real activity directly, that would factor into the Fed's analysis. Goolsbee says a fear is that the data is lagged and upcoming reports will show a more serious impact from actions already taken. And Fed Goolsbee says in the short run, the Fed needs to wait for the dust to clear. The bar for action is higher until that happens. And Fed Goolsbee says 50% tariff rates, or rates that are that high, would be scary for the supply chain. The EU Commission is declining to comment on U.S. trade tariffs until a call between EU trade chief and the U.S. trade representative takes place. And the Polish trade minister says Trump is showing that he wants to reach a deal as quickly as possible with the EU. We share that ambition. Deutsche Bank said today the U.S. economy is experiencing death by 1,000 cuts. Now, the percent of stocks trading above their 50-day moving average has definitely reset lower quite a bit over the past couple of days, now at 55.5%, which is pretty well historically average for markets. And now, for the first time in a long time, the AI Investor Sentiment Survey shows more bulls than bears. Okay, bullish investors at 37.7%. Bearish investors at 36.7%. So 1% more bulls than bears, but that bear percent is still well above historical norms, or I mean, even really what we've seen in the past couple of years. Like, it's still pretty unprecedented. Neutral investors did climb a lot as well, though, from 19.7% to 25.6%. So more people turn neutral, more people turn bullish, less people are now bearish. But still, again, there's a lot of bears out there, and I think that could continue to fuel markets to move higher. But we are still vulnerable for any of these random headlines that come out and whatever Trump is feeling on any, given day. The CNN Fear and Greed Index today coming in at 63. Yesterday, you were at 66. So now you're around the midpoint of greed, a little on the lower side. Market momentum, extreme fear. Stock price strength is greed. Stock price breadth, extreme greed. Put and call options, fear. Market volatility is neutral. Safe haven demand, extreme greed. And junk bond demand, also in extreme greed. Now take a listen to this clip on CNBC where this individual says, despite a lot of the headline risk, despite what's going on in the bond market, stocks are poised to make new all-time highs. My expectation is we're going to have a 20% rally from now into year end. I know that sounds absolutely crazy, right? I get it. But if you're not paying attention to what's happening, it's going to sound crazy, right? Deregulation, lower taxes, no tax on tips, no tax on overtime. That could help push or pull the bottom half of this country out of a 3.5-year-long recession. Okay, just that in and of itself, I think, is huge. I don't see there being a recession without massive layoffs, and I don't see the layoffs I don't think we're going to get inflation from tariffs, because inflation is always a money printing phenomena or a monetary phenomena, and we don't have that. Okay? So I think the Fed's going to be in a really good position to cut later this year without inflation. Mix in, AI deregulation, lower taxes, maybe freer trade with other countries. And I think you have a very good backdrop for stocks. And I think a lot of people are missing this right now, and that's fine. People are going to miss it until everyone realizes it at the same time. By then, you're going to want to be fully positioned in markets. So I'm just giving you a really big heads up of like, hey, this is coming. Now, I'm not a financial advisor. I'm not a financial planner. I don't have a crystal ball. Things can obviously change. And when the markets are so heavily correlated to what one person says, Trump, you're bound to get some, push and pull over time. But I do think we're in for like a 20% rally from now into year end over the next 6 months. But take a listen to this clip.
What do you make of the futures just kind of making a move to the downside in the last 20 minutes or so?
Well, it seems pretty muted, but remember, Frank, if you look at the S&P futures right now, up 1 point. This is off of a week. Last week, the S&P 500 was up 5.5%. We saw a parabolic move in the NASDAQ 100 up about 7.5%. So if we go back to April 7th, the lows we put in after the trade tariffs, you've seen the S&P 500 bounce 17.5%. That's amazing. And I think it's been really perplexing to a lot of people who are either selling the bottom, who are underinvested. But right here, right now, I think this is quite healthy to see the market try and find his leg to see if it can take another leg higher.
All right. Jeff, your word of the day is poised. Why, though? Who's poised right now? It seems like a lot of people are getting upset and panicking, specifically when we're talking about bond investors and people looking at the potential deficit increasing spending bill that just passed the House.
I would say the market is poised, Frank. There is certainly a lot of noise and a lot of indigestion out there, but what seems is the market is poised, and that's why is my WEX word of the day. It's poised to test the new and make a new all-time high. So I think we're only about 4.5% away from that all-time high we put in earlier this year. And when the market seems like this, it's almost like trying to take a basketball, keep it underwater. It doesn't have that ability. So I think we retest new all-time highs in the short-term future.
All right, so again, the bond yield spike after that Moody's downgrade of the U.S. credit rating. But the last few days, we've really seen muted moves. I think yesterday, the S&P was down like 0.1 or 0.2. It was a very slight move to the downside. Mike Wilson from Morgan Stanley, he was on our air yesterday talking about his thesis when it comes to this muted move in the market. I want to hear from him and get your take.
Well, our math tells us that retail is buying about $5 billion a day, okay? CTAs and systematic strategies are buying about $5 billion a day, and corporates are now buying because earnings season is over. That's just a lot of money. And so, like, where's the, like this? If you get any selling, it just gets stopped up in the near term.
So, Jeff, I want to get your take. He also added that if the market declines by about 5%, that dynamic could change.
Yeah, I think he highlights the fact that there was a wild bifurcation in the month of April. Typically, you see retail selling in that type of distress and institutional buyers stepping in. It was just quite the opposite. You saw institutions having to deleverage, and that goes back, Frank, to the fact that we saw such an over-concentration in those Mag 7, those top 7 names of the S&P 500. So it is an interesting time, and that's why I think the market has the ability to go higher. But in relation to the bond market, I cut my teeth in the bond market. I traded U.S. Treasury futures for over a decade in Chicago. And I think that move we saw on Wednesday, it was actually more muted. There was more noise and reaction due to the fact that we saw only about a 10 basis point range in the 10-year. And the 10-year right now is right back down to 4.50%. But I think we saw more profit taking, Frank. That's why we saw that acute move lower in the Dow as well as the S&P 500, because we had such a bounce off of April 7th. So I think there's more in play of profit taking versus people freaking out and panicking about the 10-year note at 4.5%.
Are bonds attractive right now? And if so, what end of the curve would you look at if you were looking to buy some bonds?
Well, I think Warren Buffett would say absolutely the bond market is attractive. He has $348 billion sitting in short-term Treasury bills. So I think you're going to see that dynamic. But the one thing that's not talked about enough, being a former bond trader, is that we are seeing about $8 trillion maturing this year for the federal government in 2025. Give or take $1 trillion, Frank. That maturity is allowing bond traders to say, I want a higher coupon. I want more juice. Give me more interest if I'm going to be participating and demanding these bonds. And that in itself is why I think the 10-year note is higher. We're actually seeing cooler inflationary data, but there is a lot of confusion and perplexity about what these tariffs potentially could bring down in Q3.
Give or take $1 trillion. You don't hear that very often.
No, you don't.
Jeff, I want to get to your pick for today. What's your pick and why?
Visa. This is the behemoth. This is an essential name. If you look at the market cap, it's almost $700 billion. The closest is MasterCard, obviously about $500 billion. Look at American Express, way down at $200 billion. In this name, it's only about 3% away from its all-time high, Frank, but I think it has momentum. I think you're seeing the consumer spending. They continue to expand in other countries. They're in about 200 countries right now. With a forward PE of 31, I'm not saying it's cheap, Frank. You look at MasterCard with a forward PE about 36. I'm just saying there's momentum in this name. And when you see this type of distress and volatility, look at the VIX, still at 20. When you see this type of volatility, people go up in quality. People want to own these essential names, as I own in my Essential 40 ETF, Frank. So going into a quality name like Visa is going to give you an opportunity. If you do see these interest rates go higher, people are going to sell what they don't know, and they're going to buy what they need.
Let me know your thoughts on all of this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.